Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. The RBI monetary policy was as expected with no change in rate or stance. Mr. Das delivering yet another smooth policy that failed to generate any major moves in the market. The jobless claims from the US had the attention of the markets. Now the Fed is keenly looking at the job market weakness, and so data which provides insight into the job market situation is looked closely by the markets. Good morning, JK. Your thoughts on the monetary policy and the jobless claims?
Yeah, good morning, Swaraj. Yeah. So no one really expected any change in the policy of RBI, particularly with reference to rates and the stance that remain unchanged. However, market was looking for some clues on when the RBI might be ready to move on the rates, particularly when we are looking at many global central banks already cutting and Fed maybe on the verge of cutting in September. But from this point of view, I would say that RBI actually sounded hawkish because he repeatedly emphasized on the sticky food inflation, which can spill over into the broader inflation, and even the core inflation can inch up, which has been lower so far. He also mentioned about the growth being strong, that gives more space for them to focus on inflation, and said that reining in inflation would actually help sustained growth. He also mentioned that India is guided by domestic factors and not foreign countries' policies will not influence it as far as the monetary policy is concerned. So all this leads me to believe that we will not have a rate cut before December this year, and nothing to take away from the policy for the markets. Neither the stocks, which are anyway still undergoing some consolidation, bond market unmoved almost, and then the currency anyway, which is guided by flows and RBI. So monetary policy was a non-event for the markets in India. Rupee was again slightly higher, or rather slightly new high on a closing basis, but nothing to write home about because it was in a very tight band again. Good demand, again FII outflows seen. Possibly some unwinds are still taking place from foreign investors in the Indian stocks, and that's what is keeping the flows on the negative side. But there were ever presence of RBI ensured that the rupee did not again weaken beyond 84. But looking slightly ahead, I think the geopolitical uncertainty and political uncertainty of elections in the US, and as well as when the Fed and the US economy will give a more clear sense of rate moves, will keep the rupee somewhat range bound to slightly weaker. 84 break eventually can be expected and move towards 84.15. That's slightly on the medium side, a medium term basis. On the global markets, risk sentiment definitely improved. Good news is good news because jobless claims came lower at 2,33,000 versus 2,49,000 of last month. So what we saw was a recovery in stocks in the US, sustained, unlike the previous day when the recovery was given up. Dow 1.7% up, S&P and to Nasdaq well over 2% higher, and Asia has definitely followed. Japan has recovered more than 13% from the lows hit on earlier in the week. Even Japanese yen, fresh weakness has sustained above 147 now. 145 has now become a strong support. Soothing statements from Japanese officials about not tightening further when the market conditions are not favorable has helped probably fresh carry trades by the investors as well. So I expect more recovery in the markets because they look a bit oversold in the short term. Although carry trades, might get unwound if again once again, Japanese and it sees its bottom, but that has some time to go. And before that, we have lots of data to digest from the US next week on the inflation front. Bond yields, again, like the stocks, bond yields also jumped yesterday. 2-year settled above 4%. Not so good response to the 10-year auction by the Treasury also helped the yields go up. So inflation obviously is the next focus for the bond market as well. We had some good news on the inflation front from China this morning. CPI inflation year on year came much higher than expected. In fact, 0.5 versus 0.3% expected. So that has helped the Chinese yuan to some extent. Possibly don't expect immediate further rate cuts from the Chinese central bank as well. And if you're looking for some Fed reactions, I think the Mr. Smith, who is the Kansas City Fed member, who will be a voter in 2025, he said that we are close but not quite there as far as the inflation is concerned. He also said job report led to some question on economy's resilience, but other indicators are on consumption, etc., remain strong. And in another interesting news, Kamala Harris has widened her lead over Trump to 42 versus 37 in a poll that was published yesterday, and this is much higher than the 37 to 34 that was over Trump. So this is an ongoing and evolving thing, and we will look forward to the next debate that will be on air on September 4th between Harris and Trump. On the dollar, better data helped the risk currencies to recover, particularly commodity currencies. Euro continued its rangy behavior. Recent weak data from Europe, but at the same time, slightly higher inflation keeps the rate cut expectations from ECB balanced, so euro remains in the range. Japanese yen obviously is the most volatile of the currencies. It has not broken the 148 again, but I think as risk sentiment improves and market gets the confidence that BOJ is unlikely to move immediately on the rates once again, we may see a move towards 150 and possibly towards 152. But I think around those levels, BOJ might become vigilant, and we might see some action of intervention from them. So, but for the time being, I think the sentiment will be guided by Japanese yen moves. And finally, on gold, we have seen repeated sell-offs from about 2450 levels as investors have tended to book profit on their hefty gains, particularly in the context of big losses incurred elsewhere. The recent behavior of gold has actually been, selling gold when the risk sentiment is negative and recovery with the risk sentiment. This is quite in contrast to the traditional moves in gold when it actually rises when the risk sentiment is poor. But that's what is guiding is the books of the investors and the traders. So whenever they need to make up for their losses, they are selling gold as well. So this is a temporary phenomenon. I think eventually gold will move on its own based on rate cut expectations, about which we'll have some indications next week as well. Technical levels to watch for gold: 2435 and 2470 on the upside, and 2370 and 2350 on the lower side. Thank you.
Thank you, JK. And just to quickly summarize with respect to RBI monetary policy, as JK mentioned, it was a little hawkish as RBI remains cautious on the sticky food inflation, and it seems that the rate cut is quite far away for India, maybe even as far as December. Jobless claims lower, it resulted in good news being treated as good news for a change. So the recovery in stock sustained a recovery we have been seeing post the carry crash, which was triggered due to the Japanese yen and the rate hike by the BOJ. Bond yields jumped. 2-year US yield comfortably above 4% now. Japanese yen also, it's trading on the weaker side, comfortably sustaining above the 145 levels. Chinese inflation came higher, which helped the yuan, and euro remained rangy, but dollar remained a little higher. That's it from us today. Thank you for listening. Have a very good weekend, and we will see you all on Monday with the latest in the financial markets.